Welcome back everyone, my name's Paul, I'm brand new to invested, yada yada yada. Here's my portfolio. Welcome to my dividend reinvestment portfolio. Initially it was a dividend reinvestment portfolio. It still on the whole is, but this has gradually over the past 3 years that I've been investing, has gradually become more of a cash flow, more of a return to shareholder policy kind of portfolio. All these companies here are returning in some way or another back to shareholders, whether that's through share buybacks, through paying off debt, or indeed dividends. The majority of this is dividends, and I feel like I should be heading a lot closer to dividends. I've done videos on the past all about how I think that dividend paying companies and share buyback companies, companies that give back to their shareholders, are on the whole generally more successful in the S&P 500 and generally outpace the market. And instead of investing in high growth stocks, really chasing that growth of those quick stocks that are going to make you a lot of money, I have decided to go for the boring route. And I feel like a lot of the companies that I'm investing don't have the same risks as what the high growth companies have. That's not to say that they are more or less risky. I just feel like they have different risks that I feel like as an investor I can cope with. Whereas I don't think I can cope at the moment with Elon Musk going on Twitter and telling everybody that his factories are all cash burning machines. I mean, I think in a way Elon Musk tries to control the share price by saying these random things and then having big old results come out later. I think he did that the other week when he was talking about cutting 10% of its workforce, when he knew damn well he wasn't cutting 10% of his workforce. He was only cutting 3%. So the news looked better afterwards. I'm going to see if these big gigafactories are actually burning as much cash as he just said they are today. If it comes back in a couple of months that this was all a bit of a lie, then we can start to see a pattern of how Elon Musk manipulates the market. And then I might be more comfortable investing in Tesla because I start to understand how their CEO works. Crazy fucking guy. But until some of those massive growth stocks start to become really valuable and giving back to shareholders, they have to at least become profitable. I'll be sticking to these dividend reinvestment companies, these dividend growth companies that I feel comfortable investing into. Current invested value is 47,827 and I have a full portfolio value of 49,326 because I've got 1,498 to put back into the market. The whole point of this channel is an experiment to show if investing actually works. Every time I upload, I show my portfolio off and I try to show the ins and outs of what I've been doing every week, the ups, the downs, everything that you see on here is how I invest. And while we're going through a really bad time, I want to show this to you and I want to show you that even somebody with a normal job, without YouTube money and stuff like that, can do this investing thing. The ultimate goal is to get financially free, and we're 3 years on now and it still feels like we're a long way from that 450,000 number. But I started recording this video 2 days ago, and 2 days ago this market was in a complete ditch, and today it's Friday and we've had a massive rally. I don't know if this is a bear market rally or if it's just the start of the next bull market. And it's pretty scary to me because a lot of the companies that I was going to invest in, ones that I was going to show you why I was investing in, have really rallied, and I don't know if I want to invest in them right now. Some of these companies which I wanted to invest in have gone up so much that now their value principle is a little bit out of whack. Like Segro. Segro was one I wanted to invest in the other day. In 2021, it was at its all-time highs, and now it's around 30% down. I wanted to invest another £1,000 into this yesterday because it's an amazing dividend growth stock. It owns loads of property. You would have seen the Segro parks if you live anywhere near London, Derby, anything like that. You would have seen the Segro industrial estates and how massive they are and exactly what customers they've got inside them. I believe that Segro is going to be a massive company going forward, but it's trading quite heavily over its net asset value. 2 days ago, it wasn't. 2 days ago, it was 10% down from where it was, and I was going to put around £1,000 in, but today, I don't really want to. 2.4, nearly 2.5% is a great dividend yield for this company. I am going to put a little bit into it, but not as much as I was going to, unfortunately. But also companies like Amazon have gone up 10% in a couple of days. ASML's just gone up 5% just today. I'm probably going to put some more money in this, but oh my God, this is not helping. And I was going to put a lot into Lennar, but it's up 11% on the week. In a bear market, with a recession coming, I just don't feel like the price is going to stay here. And this is the fight that we have to have with ourselves as investors. Even if the market is going up one day and down the other, you can't really time the market. No one knows where it's going to go. And the best option, and the option that I'm sticking to, is that I have to cost average into it at all opportunities. So I'm still going to go ahead with buying, but anything that I think has ticked over that mark of value in the past couple of days, I think I need to hold back a little bit. So I probably won't be putting in £1,000 today, but I will have a look at what we've got. So the portfolio sits at 47,856 today. That's an unrealized gain of 8.94%, which is quite good. Considering some other people out there are probably 60-70% down. I'm considering myself quite lucky at the moment, but my actual total return is 13.036%. So we're going to put this into my little formula right now, and I'm going to write my portfolio down as 13% dead on. And my current investment into the S&P 500, that's VUSA, is 7.64%. 7.64%. That quite nicely shows that I'm still a little bit ahead of the market. It's grown a little bit in the past couple of weeks, which is pleasing, but I still think this market hasn't bottomed yet, and I'm still not taking any of this for granted. I think that the market is going to consolidate. I think some of the bigger dividend paying and share buyback stocks are going to fall pretty much just as far as the big name growth stocks, which a lot of people have suffered from. Whenever I deposit some money into my account, I always deposit 5% of it into the S&P 500. This helps me track that progress against the S&P 500. And I also think that investing in the S&P 500 isn't such a bad thing. Before I do anything, I have to invest £50 into the Vanguard S&P 500 ETF. It's 8 o'clock on Friday night right now, so that's going to go in on Monday morning. It's just one of them things. I am knackered right now because I'm always at work and I never get to make videos anymore, which is a real shame because I really enjoy it. And so we've got £1,500 left to invest in the market. And there's a couple of stocks that I want to add a little bit more to. And we'll have a look at my ratios as well in my pie just to see how badly we're matching up at the moment. First of all, I think ASML today is going to get some of that pie. ASML, according to Fastgraphs, by all accounts, is considered overvalued. I really think that this is a little bit scary for ASML, but if you set it at a future PE ratio of 16, you actually start to see that in 5 or 6 years, if you continue to consider the current growth rate and the current free cash flow rate, we start to see some really good numbers from ASML. I think that because ASML has dropped a good amount, 43% from all-time highs, I think this is getting to a reasonable time to buy into a really good growth stock. Ray Dalio has decided to short all of Europe, and ASML was highlighted as one of the biggest companies that he shorted as well. That was bad news, but I'm not sure Ray Dalio knows exactly what ASML is. To me, ASML is the cornerstone of all technology, and I think a lot of other people believe that too. I don't think there's a world right now or in the next 10 years where ASML doesn't exist as one of the biggest companies of the world. Morningstar also agrees quite considerably. It hasn't given many stocks 5 stars for a long time. This market has been overvalued for such a long time. There really has not been that many 5-star stocks other than oil stocks. So to see a wide moat company with a high return on invested capital trading at $485 when they think it should be worth $800, I'm starting to think this is a pretty good time to buy. So today I've just taught myself into adding a little bit more of ASML. Today I'll be adding £300 straight in. I don't want to add 300 shares. I can't afford £125,000. But you can, but of course on Trading 212 you can go to value, you can type in 300 and that will give me 0.7 shares. Oh, that's depressing. The next stock I think I'm going to add is JP Morgan Chase. Now on Fastgraphs, JP Morgan Chase isn't a brilliant stock to look at because we do like to look at banks as more a price to book value rather than based on earnings. But as you can see historically, we do have a stock that trails its earnings quite well. And based on this very crude representation, and I take this with a bit of a pinch of salt right now, it turns out JP Morgan is 46% undervalued, and that's a total annual return of 19.2% a year. I'm not entirely sure about that, but if we go to Morningstar, we see that actually this isn't such a bad stock. With Morningstar continuing with a wide moat rating, 113 was the last close and 151 being fair value. And what got me really interested in JP Morgan today was the bank stress test. If you don't already know, banks have to undergo a stress test every year since 2008. 2008 brought in a lot of new rules, and now all banks have to have a cash buffer to keep them from going under during a recession. The stress tests run a lot of different scenarios and have shown JP Morgan is very good under this stress. Whether or not this company will achieve quite high capital appreciation, I don't know, but I do know that it's very likely to not lose me money. So I'm actually 8% down on JP Morgan right now. FX Impact has really helped me out. So I'm going to put in a tiny little bit of cash going into JP Morgan today. Let's start with £150. Just because today it's gone up so much, I'm actually really gutted that it's gone up by, how much has JP Morgan gone up? 2.77% today. And we know on Monday it's just going to slam into the floor. Right? Next up is one of my big companies, Lennar Corp. I'm still banging the drum on this, even though it is likely to suffer in the coming years due to high interest rates. I still believe that housing inventory is still really low, and I think that Lennar Corp is investing in the right areas. It's picking the areas where it sees work from home customers going. It sees people coming outside of California and going into the other areas where they can work from remote locations for cheaper. That's the plan with Lennar. I think they have a good idea going forward, and I'm happy to invest a little bit more in them. Not too much though. £100 going into Lennar Corp today. The next company I'm going to invest in today is Broadcom. I apologize that I'm going through these so quickly. I just want to fly through these today, and I promise in the near future I'll be doing a lot more of a deeper dive on these companies and why I'm investing in them. But today, the simple reason for getting into Broadcom is this massive cash flow output and how below its cash flow values it is. A company is worth the present value of all future cash flows that it's going to return to a shareholder, and Broadcom has loads of it. The only issue that I would say with Broadcom is that it tends to increase its revenues and its output by acquisition. So it recently bought VMware. It's trying to go a bit more software because it's quite limited with the RF inhibitors, but Morningstar has Broadcom as a 4-star stock, which is good in my books. Obviously, we only do little drips and drabs. We dollar cost average, but today we're going to put a little bit more into Broadcom. Let's put £200 right into Broadcom. And finally, Warner Brothers Discovery, one of my more riskier plays, but I feel like this company is at such good value that I want to put in more consistently. I must be quite heavily down on Warner Brothers Discovery right now. I haven't really calculated how much. It's probably around 30%. It could really be that close. If you include the AT&T spin-off, yeah, I'm probably 20 to 30% down on Warner Brothers Discovery right now. Again, Morningstar has it as a 5-star stock, and I really would say this is one of the pinnacles of a 5-star stock, really. Not because the company is so good. I mean, it's a good to great business, but it isn't the best business out there. It's the value. It's how much there's likely to be a multiple expansion going on for Warner Brothers Discovery in the next 5 years. Fastcraft clearly shows here a complete drop in earnings going into 2022, and that is expected. This is the part where they're trying to deal with all the merger stuff. But look at the expected growth coming in the next couple of years. You've got the 2 Game of Thrones sequels coming out. One has Kit Harington in it, apparently. It's going to be incredible. That's going to be a big driver for Warner Brothers Discovery. It's not the only driver. Obviously, there's going to be so much more. I think Discovery and HBO are going to merge, and they're going to start spreading out into different countries. That's one place that it is behind Netflix, is that it's not in any other countries. Warner Brothers has so much further to grow as it goes international, and it doesn't stay solely in the US. There's so much growth here for Warner Brothers Discovery. I think this isn't too far off, this multiple expansion to 11. You've got a 26% year-on-year return. That's 87% growth expected in the next 2 to 3 years. I'm obviously going to take that with a pinch of salt, but I think the margin of safety is there. I understand it has problems with debt, but it is paying down, and David Zaslav has a very good history of managing debt. Warner Brothers, I think, has a big opportunity coming in. I'm going to load up a little bit more today. 300 quid going straight into Warner Brothers Discovery. Let's see where it goes. In the short term, I think there's going to be a lot of pain. Long term, I think Warner Brothers Discovery really has a real opportunity going forward. So that's my video today. I have about £398 left over. I think I'm going to put that into SeaGrow once I've done a little bit more analysis of it. I just want to make sure that it's the right thing, but I've wanted to invest into SeaGrow for so long. It just got so far away from me. Now it's back into a reasonable range. I want to put more in. We'll see how that goes. That might be something I have to do next week. Thank you very much, guys, for watching, and I'll see you when my next upload. which isn't very often at the minute.